This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm Adam Scalena. Cory, you look like you were wearing headphones last night.
I'm not going to lie to you. I'm a little on the tired side. I was very fortunate, and I will give them a shout out. Business in Vancouver.
Yeah.
I took a whole bunch of us to a box to see the Chili Peppers.
Wow.
Yeah. And also a big thank you to Chris May, who runs BC Place, who also was a 40 under 40 winner this year that helped put the whole thing together.
My neighbor,
and,
2 doors down.
Oh, is he?
Yeah, he's a good friend.
He's a great guy. Super good guy.
Yeah.
Yeah. So the whole thing got put on by them, and it was an amazing, amazing time. City and Color opened. They had drinks for everyone. There was food for everybody. Sat in a box, so you didn't have to worry about getting pushed over. And it was great. Unbelievable concert. One of the best I've ever seen in my life. And
I hear they put on a good show.
It's well, I didn't know this. Okay, I was reading this like the day of the show that Anthony Kiedis was like 60 years old.
Really?
Yeah. And like Flea was like 60 years old or something like that. So I guess it makes sense now. I remember I was like in probably like grade school. Remember when Costco used to sell CDs and like get the Costco CD with the big plastic thing on it?
Sure. We didn't have Costco in Winnipeg.
Yeah. Oh, that's right. Sorry. Sore spot. In BC here, we had Costco. And
we had Sam the Record Man. Go ahead.
And you get the Chili Peppers CD like in high school or in elementary school, right? And then high school and stuff. So it was an awesome show. Like every song you like knew. It was just amazing. Amazing. So a big thank you to the team at PIV and Chris May for putting that on.
So pretty energetic act for guys in their 60s?
They did not look 60. I was more tired than them, and I was watching the show. So it was tremendous.
You know, Matt had an opportunity to get ground floor seats for free, I think.
Oh,
is
wow.
the story.
Yeah.
Because somebody couldn't use them. And he was like literally putting on his Chili Peppers sleeveless shirt, getting ready for the night, headband and everything else. And it got canceled last minute. So he, but he would have been there on the ground.
You know, this is going to sound like a fake story. This is a true story. I was driving into work that day.
Yeah.
And I definitely had my Chili Peppers a little too loud in the car. And this guy pulls up on a light on Dunsmuir and like Richards next to me.
Right.
And he looks over and he can hear it going.
Yeah.
And he had a collared shirt on, and he pulls the collared shirt down, and kind of on his collarbone, he's got the Chili Peppers logo.
Oh, nice.
So I'm hoping the guy's going to the concert. That's
you
dedication.
pulled up the bottom of your shirt and showed him your lower back.
Yeah, so I took my shirt off. I showed my lower back tattoo of the Chili Peppers and my tribal band. So, cohesively, we could go to the show together. Yeah. But that was a diehard moment. I'm like, if you get a tattoo of a band, I don't even have a Nickelback tattoo. And you have a tattoo of the Chili Peppers on your like collarbone area. Like, what are the odds of that? This guy was like ready to go.
The band tattoo. Yeah.
The band tattoo, but tremendous show. Amazing show, amazing energy. Those guys just gave it, and like they do not look 60 years old, that's for sure.
So welcome back to rock bands from your childhood podcast.
I know.
Who do we have on the show today?
So today we've got our great friend Alan over from Impact Commercial. So we kind of did a pivot with some of our guests, and they were very cordial to kind of like, we moved them all around because we wanted to get Alan on.
Yeah.
Because obviously what happened down south with the collapse of the Silicon Valley Bank is having impact on their interest rates. Everyone anticipates. If you look at a lot of reports like Bloomberg and stuff like that, bringing out historicals and all that stuff of what happened during financial crisis, the Americans got to restore, the feds down there have to restore confidence in the banking system. So typically how they do that is they lower interest rates, which recently they went up 25 basis points on Powell's announcement. The feds down there are kind of in a rock and a hard place. Like, we have an inflation issue, but if we lower rates, we're going to potentially fuel the inflation problem we have. But if we don't lower rates, how do we create confidence in the American banking sector? So we reached out to Al right away, said, hey, we need you to come on. We need to break this down for the listeners here. We need to find out what's going on, because if you look at a lot of these reports coming out, one report or prediction I saw is they're anticipating the American rates, not ours, could fall as much as 75 basis points by the end of this year now. And that's anticipating with trying to stabilize the public's perception of the banking sector down there, right?
Yeah.
And obviously Silicon Valley, which Al will dive into, was probably much more diversified in the tech sector based on their name.
Sure.
Right. But they were the 12th largest bank in the States when it happened. So that will have impact on how their economy operates and how those interest rates will. Us being a mirror of that up here, our economy is probably not too big enough to function without them, that we almost have to follow suit in a lot of ways. What does that mean for our rates? Could our rates come off?
Right.
50 to 75 basis points this year, which would be sort of a year earlier than originally predicted, which no one saw this coming. So we reached out to Al and said, hey, we need to come on, we need to talk about this, get this information to listeners right away, dissect this information so people can make decisions. So Al's joining us today to break that down.
There's so many takeaways when Al's on the program. Super excited about this. Why don't we cut to this conversation with Al?
Yeah, no, let's not waste any time. Enjoy, guys. This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes under the commercial umbrella. You're building a building in development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say, over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion.
Okay, so we're here with Alan Haigh. He's the founding partner of Impact Commercial. How you doing, Al?
I am doing awesome, guys. How are you doing?
Good, thanks. Thanks for joining us.
Thanks for coming back, I should say. A highly anticipated six-pack coming later this episode. But let's start, Alan. Past guest fan favorite. Can you tell us a little bit about yourself?
Okay, so you guys, obviously we've known each other for many, many years. Founding partner of Impact Commercial Group. We are a niche commercial mortgage brokerage focusing on BC and Western Canada in regards to supporting our clients with their commercial financing needs. Really pleased to have a great group around us. There's 8 of us, and I have recently transitioned just to, the founding partner and one of our guys, great guys here, John Switzer, which your listeners will know as well. He's taken over the managing partner duties, and he is just killing it. So it is great stuff happening at Impact Commercial these days.
Alan, I know we're going to get into a lot of talk about what's going on with rates and the economy and so on and so forth. But before we get there, we've got a lot of seasoned people that listen, seasoned commercial investors that listen to the program. We've also got a lot of newbies. Can you just describe why you need a commercial mortgage broker? I'm just thinking for the person out there who's looking to get into the commercial real estate world, and they're thinking, I'll just reach out to the person that did the financing for my condo. Is that a good idea?
It's funny, we've been in the industry a long time, and I can tell you what, when I was first doing, mortgages 25 years ago, and I was handwriting the mortgage application and, submitting it into it. And then we had the approval authority was within the branch for certain dollar amounts. And then it would have to go up to, a credit group if it was bigger than. But, the increased regulatory requirements that are placed on all the different, lenders out there, the increased complexity of commercial mortgages these days, we're so competitive within the markets now that you just don't have time to make any mistakes. You don't have any time to, misstep things. You have to be so dialed in order to be successful with acquiring commercial real estate, because the competition is very fierce in BC. And if you don't align yourself with a great team, such as the commercial realtors, your accountants, or your lawyers, you're just not going to be successful. And so, we always just recommend is clients are generally the best at accumulating their cash through their own operations of some way, but they're not going to be necessarily the best at finding the mortgage solution. So, don't try to, diagnose yourself for whatever ailments you've got, because you're not the general practitioner. Work with a specialist for the debt side and, increase your odds of being successful. And, small fee amounts are insignificant regarding, the loss of missing out on an opportunity, because those opportunities can be in the millions and your fees can be in the tens of thousands. So it's just more a matter of just be focused, right? You're in it to win it. You don't get paid or anything if you are, one of the lucky offers that doesn't get accepted, right? So
So if I'm hearing you correctly, then, so just when you're building your team, build it with commercial experts.
100%. You're just not going to be successful unless you have those, trusted advisors, confidants, mentors, within your group, if this is what you want to do.
And then right now too, me and Adam were talking about this before we hit record here with you. Right now, financing is so important in how you buy properties. You can buy a great opportunity and turn it into a pile of what with bad financing. So, having trusted professionals like Al mentioned and Al and his team there that have access to the right capital can walk you through, can provide not only probably some of the best rates you're going to see, but also like guidance on how to do it. I mean, some mortgage brokers will just put something in front of you like a 5-year fix and tell you to sign it. Al and his team will walk you through why you're doing it, how long you're doing it for. I mean, tremendous advice that comes out of there, but it's so important now more so than ever as we go into these high interest rates. And speaking of high interest rates, Al, one reason why we wanted to bring you back on the show here, down south there, we've had some little hiccups in the banking sector with the collapse of the Silicon Valley Bank. Was the larger one among, I think, a couple other what kind of went down with it. We wanted to bring you on. We've seen tons of reports out there. Just recently, the feds down south there have raised interest rates 25 basis points. Wanted to get your take on what's happening down there. How's that going to impact us? I've seen everything from, hey, by the end of 2023, we're going to see rates come off 75 basis points, 100 basis points to we may not see that up here like they do down south. Can you maybe, just explain to our listeners maybe what happened just from like a high level down south there? And then maybe I'll let you sort of dive into like how would that affect interest rates both there and up here?
Okay, so absolutely a lot of questions in there. I'm going to do my best to answer them. What I always do is I put in a little disclaimer for you guys is that, I'm not an economist. I'm not Doug Porter from Bank of Montreal or any of the other guys. So for all the listeners out there is don't hold me to that degree of expertise. I'm much more of the boots on the ground guy where I just see, a whole ton of deals coming across my desk and interacting with all the lenders and, chatting with all of our, most successful developers, most active lenders, most knowledgeable guys in the industry. And we just sort of, through the process of osmosis, we absorb this information and then we sort of extrapolate it and form our opinions. So, what happened down in the States with Silicon Valley Bank is, it's something that we were questioning because there's kind of like a trifecta. There's 3 or 4 items that I'm going to quickly talk about with that stuff there. But it's funny. I attribute these collapses of the Signature Bank and SVB as a direct response to the central bank policymakers. Historically, we've always had this mentality of boom and bust with regards to policy rates. And the problem is that businesses and especially banks need stability. They need to be able to forecast things appropriately going forward into the next 5-10 years at minimum. And what happens is that when you raise rates too quickly, you have these knock-on effects that, businesses that require stability is once policymakers put too much volatility into it, then the businesses suffer. And so this is, with Signature Bank and Silicon Valley Bank, a lot of their issues are a direct result of, the central bank policymakers rising interest rates incredibly quickly, like the fastest they've ever done it. And that's had knock-on effects on some of this stuff. So it is directly related to that. Now, should the rates have risen to this level? I don't think anybody's arguing that, they shouldn't be at this level, but it's some of those ones are the right policy makers. Probably in hindsight, they would have said we should have raised rates a lot earlier. So instead of raising them so quickly, maybe, a year and a half ago started to raise rates. Maybe the, government of Canada shouldn't be on this, drunken binge of borrowing and spending because they're part of the problem of all the inflation is that they, you borrow $600 billion, put it into the market, and you have, this massive, new supply of liquidity, which has got to go somewhere. So you have this kind of, government policy, bank policy, which caused, these rates. Now, one thing that always happens is with these rates, and especially for Signature Bank, is that they took all these deposits in from their depositors. 88% of them were uninsured. So they were generally large deposit, greater than $250,000 down there. And they take this money and then they invest it. And so what happened with SVB is that they put all this money and then they invested into long-term bonds. Okay. And so what happens with long-term bonds is like you go into a 10-year, 20-year kind of long bond, and you're sitting there, and with rising rates is that bond prices work the opposite, right? And so, you buy a bond at a 2% yield, which was a couple of years ago, and you're buying it for $98. Par value is 100, you're buying it for 98. With rising interest rates, if you're going to sell that bond, you got to sell it at $95, right? And so, you know what? That's basically where it happened, is that Signature Valley Bank, they had all these uninsured depositors. Those depositors wanted their money back. SVB had to liquidate their long bonds. They suffered a $2 billion loss. They go out to market to go, hey, we need to raise $2 billion in equity to cover our redemptions. It kind of spooks the market, and then it furthers, the run on the bank. And so you've got policymakers raising rates too quickly. You got ineffective sort of risk management policies within, Signature Valley Bank. And then you've got the, lack of consumer confidence. They just started to withdraw their money. So that just is kind of like the trifecta of what happened in Signature Bank and Silicon Valley Bank, is they all had those same characteristics that sort of merged together. So hopefully I'm not getting too technical, but it's the good old fashioned bank run as a result of that stuff. And it's, I always love about Warren Buffett and his stuff there is like, who's swimming naked when the tide goes out. And it is, these were a couple of institutions that were swimming naked when the tide went up.
So now backtracking a little bit. So now what does the Feds do down south? So this has obviously happened. There's a lack, or potentially maybe a lack, of consumer confidence in the American banking sector. The Feds obviously have to try to backstop somehow or regain that confidence. What do the Feds do down south in this circumstance?
I think the Feds have done what they needed to do, on a temporary basis. In essence, it was, an agreement where the underlying deposits, in essence, for all banks were kind of guaranteed. So it was, it stemmed the flow, of redemptions. And, so with the stemming the flow of redemptions, it increased confidence back into the market. And you can see like the market has sort of settled down now. It's a couple of weeks after, and, confidence has returned. As always, like the bigger players, better managed players, be successful at this thing here. They've swooped in and taken the good assets of these banks and left the regulators to deal with the bad assets of the bank. And that is, that's kind of where it's going to go. The Fed, I think when this happened, these cracks showed that, man, I don't see how they can necessarily raise rates as quickly as they have in the past, because we're seeing the repercussions of the speed of which they raise the rates. And I guess it kind of comes into it. I think we are, for sure, I'm going to go out on a limb and just going to say is like, we're at kind of peak rates. The Fed's not going to be able to raise rates, substantially more for here. And whether or not they increase it another 25 or 50 basis points is kind of, it's immaterial, because they've already increased it so drastically. But we're kind of at peak. We're kind of more optimistic that there's going to be a return to stability within the market over the coming 6 to 12 months.
Do you think we're moving into a period where we're going to see the rate kind of kept the same, or do you think this year we might see a cut?
Well, I got a couple of bets on here with a couple of the guys here where I think, you got to follow specifically for the Bank of Canada, because that's what we follow more closely than the Federal Reserve down in the States. But I think we're going to be in a hold period. There's a whole bunch of different sort of stuff coming in where inflation has been dropping down. So, arguably is that is doing some of the work for the Bank of Canada. But then you get a little bit of, an update of GDP today where it's, it came in at 0.5%, which is higher than what people were expecting, which is showing amazing resilience within the economy. So I don't see a rate cut for, many months, given the new information, but I do see things are probably going to be flat for, likely the rest of this year. And that's sort of kind of my expectation. If there are other certain, cracks that appear, maybe at the Q4, I could see, the policy rate drop, but I think that they're going to hold steady for the next 6 months for sure.
So if we get to the last half of this year, heading into 2024, I know, reading various sort of economist reports at the start of this year, they were kind of thinking rates, like kind of like you echo, would potentially hold for most of this year, but they were starting to predict that rates would start to come off next year. And some reports had the rates in 2024 coming off as much as 100 basis points by the end of next year. Do you guys still foresee something like that taking place in 2024 where rates will start to pull back and we'll start to get more in line with kind of where we were kind of pre-COVID-ish?
You know what is like, I do think that there is a chance of that. Inflation is coming down, and the Bank of Canada is predicting inflation will kind of get to, 3% by mid part of this year, and I think drop to 2% next year and stuff like that. But that requires acceleration of the economy. But then you know what? You come out to today, and the economy I remember it was like a 0.5% increase, for the last month. And that's much higher than what everybody was expecting. I think everybody was expecting that we would start to get into a bit of a recessionary where it would be like a flat 0% increase or a modest negative increase. But it showed 0.5, which is pretty resilient. So it's tough for the Bank of Canada to drop interest rates if we're continuing to be at 0.5%. So I think it's as steady as you go. Now, I keep thinking that there's going to be more cracks, such as the SVB and the Signature Bank. But Canada is just so robust. Like our banking system is very different than the States. Like we have the oligopoly of the main banks, and then we've got our very strong regional banks, and the credit unions are incredibly well managed and regulated by regulators. So it's like, we just have a much more concentrated banking system than down in the South, which, they have, 1,000 banks to our 10 that we have up here. So it's just a little bit different ball game. So, but I think it's going to be, flat rates for the next little bit.
Al, I'm just thinking about your business specifically. What challenges has the current rates posed for commercial financing and lending? And how have your strategies changed over the past, call it calendar year?
Great question. I can say it's client centric. We have some clients that have just done amazingly well with this thing here. Some of them, really did, sort of follow our lead or our recommendations is that we did a bunch of refinancing, when interest rates were 3%, they've been, looking and sitting on cash, and yeah, they're paying interest rate on cash, but they've been able to use that cash to get some properties that they wouldn't have had access to otherwise because they were liquid. So we've had some, very well-heeled clients be able to sort of get in there. We've had on the other end of the extreme, we've had a bunch of clients that were, just a little bit too overly optimistic in regards to the value of land that doesn't have, cash flow on it. And so we're looking at some of those ones and trying to, work with lenders as best we can, work with clients as best we can to sort of stem the blood loss as much. And then we got everybody in between. We've got a lot of owner occupiers that are still, 100% committed to purchasing their property, which we incredibly recommend. If you're going to be in a certain geographic location and you want to defend your profitability. So if you're looking at your margins, it's like you got to own your space just so you can protect it. Yeah, nobody wants to pay, the big nut and the big interest rates right now. But, you do right and you get, a 1, 2, 3 year term, you play a little bit higher. But if we believe interest rates are going to be lower in a year's time, is have that flexibility to, lock in next year and hopefully, the 5 year term in low fours. So it's a mixed bag. We deal with stuff that's, $1 million mortgage all the way up to $80 million mortgages. And we service all of, BC. So we're completely reflective of what's going on in BC, I guess is what I can sort of tell you.
Al, one question I ask you and John, whenever you guys join us here, with the current interest rate environment and stuff like that, has there been a shift in where you guys are seeing deals coming from with regards to geographical? Are you getting more deals now on Vancouver Island over the past year than maybe you were 2 years ago, or even BC Interior, because they have a little bit higher cap rates that can service the debt a little bit more? Where are you seeing most of the deals coming in? Is there a shift in that?
You know what I would say is, the biggest shift is being entirely away from land. Land is just tough right now because hard costs are too high. If you're doing a construction mortgage and you're prime plus, 1.5%, you're looking at, 8.25% kind of range for your financing. So land is definitely, being cut off at the knees, quite considerably. From a geographic, standpoint is, the search for yield is definitely there. Like we don't have really, outside of the bucket of financing for land is the buckets are full for most income producing properties, throughout BC. Just, you got different lenders in the more, secondary and tertiary markets than you do in primary markets like the city of Vancouver. So you just sort of have to, adjust it. So there's no shortage of liquidity, but yeah, people are trying to go out to, other areas to get yield in it. And it's amazing what's transpiring, with you get 1 million people that are coming into Canada in 2022, and most of them go to the large metropolitan areas, but then you're starting to see this, exodus from metropolitan areas into these secondary markets. And now you're seeing like a robust, consumer demand for, retail in secondary markets, like, in the Naimos and the Campbell Rivers and the Courtneys and all this kind of stuff. So you're seeing density go there. You're seeing wealth go there. People are investing there. And so, yeah, like a lot of the stuff is kind of getting out into these secondary markets. And you know what? Lenders are quite happy to follow them out there and support them.
So Al, as a final question here, kind of looking at the overall market, you guys are a great pressure point to sort of see if the market is going hot or cold. Have you guys seen an increase in deals come your way, say, since February?
Absolutely. What I can tell, the audience is that there has been, and we've been trying to search for some stability. And I guess the best way that I can sort of relay it is, we've seen the massive increase in interest rates. At the same time with those increase in interest rates is we saw, an increase in the risk premium that lenders are charging. So if your normal rate would be, 5%, well, lenders wanted 6%. They wanted an additional 1% just because they were uncertain if the market was going to keep going up in interest rates, and they didn't want to suffer a loss. So they put in a higher risk buffer. What we have seen just in the last month or two is that we've seen that risk buffer come off by about 50%. So, which is really nice to see. So what that is indicating is that lenders are getting hungrier to do that stuff. Their rates are coming down, becoming more competitive. And I've got more just people coming into it. And, is it, are we doing the larger deals now? Is like, no, a lot of the larger income producing deals are just not happening. They still need interest rates to come off, or the purchase prices to go down. So we're in that little mushy middle. But for the most part, is like a lot of inquiries are coming in. People are looking to deploy money. They've been sitting on their money for, a year. They think it's the interest rates have peaked and they think they're going to come down. So they're looking at good properties now. So we're just seeing more activity, doing a whole bunch of smaller little, sub $10 million ones. And we just think that this is, the mushy middle. And within probably, the next 3 months is like, we're thinking that there's going to be so much greater strength within the real estate market, assuming no like black swan events going to come out there.
Al, we always appreciate you taking time to come join us on the show. You're a fan favorite and highly requested by a lot of guests that we get emails from asking when you're next on. But before we let you go, you know the drill. We've got our 6-pack of lighthearted questions here. We got to ask you, and because you've been on so many times, you're forcing our hand and you're making us think we have to change these questions on you. Do you have a few more minutes for us?
Absolutely. I don't know how many more questions you can give me on this stuff here. I'm hoping I can come up with some quick, witty answers right on time.
The 6-pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Cory.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca. Okay, so me and Adam are having to brainstorm some new questions here just because I think we've asked you all of them here. So we're going to start off with favorite sport and sport team.
Oh, Jesus. Without question, favorite sport is hockey. Favorite team, like, I grew up kind of, a little bit more of the Philadelphia Flyers when Eric Lindros was on there. But I think I got to go with the Canucks right now.
Got to go with the Canucks. See, so the Canucks probably this year and last year were probably the best team in the league for the last 20 games, but we're probably the worst team in the league for the first 20. So it's like if we can just sort of have a decent start, we might find ourselves in the playoffs. The guys are off to a fairly good end here to the year with the Rick Tocchet era.
Yeah, Petey is killing our draft odds. Not really happy with him right now. He needs to dial it back and, let's go for Bedard.
Yeah. No, it'll be interesting to see what happens if a guy like Bedard ends up in San Jose or Arizona, how that will impact the NHL's decision on marketing. Next question up, Al. Favorite dream car? You have an endless budget. You can buy anything you want. What car are you buying and why?
That's an easy one. The James Bond Aston Martin.
Oh, that was quick. It's a good choice.
It's always been like the boyhood dream is to do that stuff there. So that one's just always a sentimental favorite.
Something you've bought for $1,500 or less has had a positive impact on your life this year.
$1,500. You know what? I would probably say that's had a meaningful impact. Probably, a nice Valentine's Day gift and roses for my wife. It was well-timed, good opportunity, and well-received.
That's a good answer. That's a great answer, by the way. Post-COVID era at the workplace, are you in a suit and tie or a sweater and a collared shirt?
Oh, you know what? It's definitely not the suit and tie. I did 20 years suit and tie, and we're not quite there, and not quite there anymore. But definitely nice dress shoes, dress pants or jeans, and collared shirt. No ties. Don't want to ever wear a tie again.
Piece of advice for our listeners in the current market environment, someone looking to buy an investment property or maybe an owner-occupier looking to buy something here right now, knowing the current circumstances out there, a piece of advice you can give them from a lending standpoint?
From a lending standpoint, it really just goes to preparation and knowledge. We had hinted earlier on is like, you got to get your team. And so I can't stress this enough, is that, commercial real estate market is incredibly competitive. And so it is find your commercial realtor, somebody that you trust. Get them on board. Find your commercial mortgage broker, meet with them, figure out what you can afford, have them model out, some scenarios for you so that you can, again, just add another prepared statement or preparation on that. Talk with a lawyer, if you're not familiar with, how to hold a commercial property, like under a corporation name, is like find out that information. Because again, like if you want to get into it, is the market is very competitive, a little bit different than the residential. Not saying that residential is any less competitive, but a lot more sharks in the commercial area than in the residential area.
So Al, fan favorite, as I said earlier, how can those guests that don't know how to get a hold of you, how can they get a hold of you and find out all the great stuff you guys are doing over at Impact Commercial?
Well, the easiest way is just jump on our website, www.impactcommercial.ca. Jump on there. We got fantastic guys here. It's like, myself, we got John, Matt, George. It's all great. So reach out to any one of us. If you want to just reach out to me, it's like always easy. My email address is on there, but you can give me a call at 604-999-2265. Always there to have a call and discuss any kind of needs that the listeners may have.
Amazing. Al, thank you once again for taking the time to join us today, breaking down a little bit of what's happening down south and how that may or may not impact us up here, and also giving us an overview of where we're at with interest rates and where we're heading. Thank you once again, Al. I really appreciate it.
Absolutely, Carl. Always love coming on this show. You guys do such a great job.
Thanks, Al. Take care. There you have it, folks. Our interview with Alan Haigh, co-founder, Impact Commercial Group.
Really enjoyed that conversation with Alan, Cory. And man, I got to say, just a quick shout out. You've worked with Alan for years.
Yeah,
I worked with Alan recently in the last year. So they really know what they're doing there.
Tremendously.
Fantastic. So, and it's funny, I get this question a lot because don't think that financing in commercial and residential are the same. If you're out there and you're thinking about getting into commercial real estate, reach out to a commercial mortgage broker and actually talk to somebody that really understands the industry and how to sort you out with financing, because qualifications, what you need to qualify is completely different.
100%. And even right now, too, in these high interest markets out there,
right?
The interest rates and how you finance these properties is more important now than ever. Whether you're buying it for long-term hold, development site, owner-occupier opportunity, repositioning the building, the interest rates and the financing and how you finance it now is more important than ever. So don't assume that when you pick up the phone and you call a mortgage broker, that mortgage broker gets access to the same capital markets as everybody else. You need to have experience right now, because the biggest difference between, you can take a great property and turn it into a dud if you apply bad financing. You can take a good property, finance it properly, and make it a great property to hold in the short term, and then as you reposition and do it later. So I can't stress enough how important the financing aspect is right now and will be for the foreseeable future. You've got to go to people that know what they're doing.
Absolutely. Absolutely. Great advice. Well, Cory, if people want to get in touch with you or anybody from the William Wright team, how can they do so?
They can reach out to us anytime at our Vancouver office, 604-428-5255. They can send me an email, cory@williamwright.ca. Always love hearing from everyone on their thoughts on the show, or they can visit our website, williamwright.ca, sign up for the latest and greatest news.
Well, great. Well, have a good week, everybody, and we will see you next week with some more great content.
Excellent. Thanks for listening, guys.
Subscribe today.